Required minimum distributions, RMDs, from your retirement plans can be a really tricky thing to navigate, and if you mess it up, it could be costly. RMDs are withdrawals you have to take from most retirement plans when you reach a certain age. The amount you're required to withdraw depends on the balance of your account at the end of the previous year, as well as your life expectancy as defined by the IRS. Now, missing your required minimum distribution will likely result in you paying a penalty tax of 25% of the amount that you missed. So the more you know about required minimum distributions, the less likely bad things will happen. And with that in mind, here are 5 things to know about RMDs. First, you need to know your required minimum distribution age. Not everyone has to begin taking withdrawals at the same age anymore. Now, it used to be that the year you turned 70 and a half was when those distributions had to come out. And that was true for everybody. Now, the 2019 Secure Act and then the Secure Act 2.0 of 2022 both changed that. It's easiest to figure it out by using your birth year. If you were born before 1951, your RMD beginning age was either 70 and a half or 72. Now, either way, you're taking required minimum distributions. If you were born anytime between 1951 and 1959, you have to start taking required minimum distributions at age 73. And anyone born after 1959, they have an RMD age of 75. Now, did you get all that? Yes, it's confusing. The next thing to know is that there's a grace period on your first withdrawal, but only your first withdrawal. Once you reach required minimum distribution age, you actually have until April 1 of the following year to get that first one done. Now, after that, all subsequent RMDs must be taken by December 31st of each year. So if you do postpone that first one, you'll have 2 amounts to take that next year, the one that you postponed and the one for that second year. Now, is postponing your RMD a good idea? Well, maybe, but you should know that taking the extra money out could push you into a higher tax bracket since each withdrawal is added to your taxable income. So proper management and knowing your tax situation is crucial here. Another thing to be aware of with RMDs is timing. Now, in most cases, we like to see an RMD taken early in the year as opposed to later. We did an entire video on that topic a little while back, so if you want to know why we prefer an earlier RMD, we urge you to check that out. But one question we sometimes get from people is this: if the markets are down early in the year, isn't it better to wait to take the RMD and hope they recover before the end of the year so that you're not selling off an asset when it's down in value? Well, here's the good news about that. You don't have to sell an asset to take cash to satisfy the RMD. If you want to hang on to that security, you can take it out of the account in kind and simply pay the taxes on the current value. And given the situation that the value is lower than it was before, isn't it better to pay taxes on the lower value and then allow any potential recovery to happen in your personal account? Well, you bet it is. This is where working with a Lucia Capital Group advisor can be especially helpful. Something else to know about RMDs has to do with multiple accounts. Your RMD for IRAs is calculated from the total of all of your IRAs combined. They look at it as one pool of money. So as long as the correct dollar amount is taken, it can come from just one account or spread among various traditional IRAs you own evenly or not. This can make things a lot simpler since you don't have to take separate distributions from each IRA. But keep in mind, you cannot do this with a company retirement plan like a 401k or 403b. If you've retired completely, you have to take a separate RMD from each 401k, 403b, 457, or other retirement plan that you have. The last thing you need to know are the tax implications. As I said earlier, these RMDs are added to your taxable income, which means that if they're large enough, they may wind up not only pushing you into a higher federal and state income tax bracket, but may also push your Social Security benefits into the taxable column and may also subject you to higher Medicare premiums. Because of this, the time to think about your RMD is not when you're required to begin taking them out, but probably several years before that. If you can find a way to reduce your RMDs over time, you may save yourself a lot in taxes later on, maybe for the rest of your life. Yes, RMDs are often tricky. We at Lucia Capital Group strategize with our clients every single day on ways to potentially reduce the impact of RMDs. If you're concerned that you may one day be overpaying in taxes, just give us a call. As always, we're here to help.